Hello everybody, I am Ms. Minakshi Dubey from Kotak Mutual Funds. Today I will be starting with a new module known as Handling Investors' Emotions. This module has been divided into 4 parts. Each video will be approximately of 10 minutes. So let us start with part A of our module Handling Investor Emotions. There is an old saying that the market is driven by just two emotions, mainly greed, and the other is fear. Although this is a simplification, it can often be true. Succumbing to these emotions can profoundly harm investors' portfolio. As when driven by these emotions, investor tends to enter into the market at a wrong time, and then out of fear his exit is also at the wrong time. Let us have a look at greed and fear. The greed and fear matrix here will give you a brief idea about the stages of these emotions and their after effect. This also proves that when any emotion turns out to be excessive, it can be harmful. When I have to talk about greed, when greed is in moderate, it helps in self-motivation. It encourages one to focus and achieve desired goals and results. On the other hand, if greed turns out to be in excess, it grows into get rich quickly mentality, resulting into higher unsatisfied levels with whatever one has. If fear in moderate, it helps to be disciplined. It helps in keeping check on your emotions and actions. But when excessive fear is developed, it scares a person to the extent that he or she cannot even take the calculated risk. They are always tend to have fear to lose what they have. Let us see influence of greed. Now, most people want to get rich as quickly as possible, and bull markets invite us to try it. The internet boom of the late 1990s is a perfect example. At that time, it seemed all an advisor had to do was pitch any investment with .com at the end of it, and investors leaped at the opportunity. This get rich quick thinking makes it hard to minimize a discipline. It also makes it difficult for the long-term investment plans. It's times like these when it's crucial to maintain an even base and stick to the fundamentals of investing, such as maintaining a long-term horizon or a rupee cost averaging thing. Instead, on the other hand, what one does is he adopts the herd behavior. The herd behavior could be in terms of buying or selling. When I talk about influence of fear, just as the market can become overwhelmed with greed, it also succumbs to fear. When stock markets suffer large losses for a sustained period, investors can collectively become fear of further losses. So they start to sell. Just as greed dominates the market during a boom, fear prevails following its burst. To stem losses, investors quickly sell stocks and buy safer assets that have low risk. As I said, people or the investor prefer moving to safer asset classes. Economists have a name for what happens when investor buy or sells just because everyone else is doing. It is known as herd behavior. The outcome of greed and fear. The outcome of emotions like greed and fear are going to be harmful for investors' portfolio in the long run. The point to be noted here is that in all the situations, the possible outcome would be either a no decision or it would be a wrong decision. Well, to handle investor emotions in these times is the most crucial thing, because if you are able to manage your investors' financial emotion and this time, then you might have the investor stay invested for a very longer time. So the question is, how do we cope up with the current situation? As there is a lot of volatility leading to fear in the market that we have to travel through. So when I have to talk about fear, let us see what fear means. Fear is nothing but it is a false evidence appearing real. Wherein this is more of a thing wherein the investor starts feeling that if I don't sell my schemes at this point of time, I may bear losses in future. That is the fear. Now, let us also see what are different types of fears that can come to investors' mind. First of all, fear of life, fear of his own life in the current situation, fear of losing a loved one, importantly, fear of running business. Economic fear is another important factor here. Well, many people are running behind or running away from the fear of survival. Everyday survival is a question for a lot many people. And the fear of losing the hard earned money. This brings us to a very important point, that how we manage investors' emotions. The fact is that for every investor, the pain of losing money is more than the feeling of enjoying the gains. The natural instinct of the investor here is to flee the market when it starts to dip. Just as greed prompts people to jump back in stocks when they are skyrocketing. But importantly, if you see in both the situations, the impact is going to be negative. But some investing can overcome the power of emotion by smart investing. Now, if we have to do smart investing, we have to focus on four very important parameters. Those are relevant research, solid data, proven strategies, and strong fundamentals of the scheme in which you want your investor to invest. Now, it is very important for an advisor to delve deep into these four focus points and then suggest the investment schemes to the investor. Here, if you see, investor has a mixed emotion according to the ups and downs in the market. The journey starts from being very optimistic, being hopeful about his investment. As the market moves up, investor exhibits great happiness with growing movement of his money. The moment there is a dip in the market prices, the emotion changes into nervousness, further followed by fear in case of further dip. Now, if you realize we are currently somewhere here at this point of time, maybe people who can have patience at this time might soon see the market booming up. Well, so you see, investors' emotions keep changing according to the market performances. Well, this is all that we have in part A of our module. In a part B, we will discuss about few principles that can be adopted to handle the investor emotions. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.